You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. Welcome back to the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all of the compelling option strategies that you guys can use in your clients' portfolios, as well as, of course, give you a little bit of education, answer some of your questions, talk about the hot, pressing news in the world of options. We know a lot of you guys out there are busy financial advisors, don't have time to keep up with the latest developments in the world of options, so we do it for you here on the Advisor's Option program. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-expanding, ever-exciting Options Insider Radio Network, where you can always find all of the archived episodes of the Advisor's Option. So if you're new to this program, maybe you're joining us for the first time, well, of course, a lot of great back episodes for you guys to check out, too, and a lot of great topics. Easiest place to find all of those, as well as the other 14 programs on the old network, is the mothership, the flagship, theoptionsinsider.com. Of course, while you're there, click on the Insider Radio Network tab, and your audio journey has begun. You can also find us iTunes, TuneIn, Stitcher, pretty much wherever you find your favorite podcast programs, including, of course, via our own mobile app available for iOS, Android, and the beloved Fire OS. All right, and joining me on the old Advisor's Option program today, let's go in order of, well, not really proximity because you guys are kind of scattered to the winds. Let's just start in order of my screen here in front of me. We'll start, he is the co-founder of Swan Global Investments, Mr. Randy Swan. Randy, welcome back to the Advisor's Option program. And where are you beaming in from today? Puerto Rico, Durango, Texas, or somewhere else they're in?
Today I'm in Durango. I spent the last month in Durango enjoying the cool summer weather in the high elevation. But I am coming back to Puerto Rico later this week. So,
it seems like we need to have a little drop on the show to saying, "Where is Randy? Where is Randy this episode?" Because he's always traveling around a little bit hither and yon. Going a little bit farther afield is also joining us. He's been on the program a few times in the past. He is Chris Hausman, the portfolio and chief technical strategist over there at Swan Global Investments. Chris, welcome back from, I'm assuming you're beaming in from scenic and lovely Puerto Rico?
Yes, I am in Puerto Rico where the weather never changes.
Yes, it does indeed never change over there. Speaking of changing, we do have an in-person guest in the studio today. Some of you listeners who listen to our other programming may recognize his voice from his many appearances on our Volatility Views program, but he's joining us for the first time on the Advisor's Option. He is Russell Rhodes. He's a senior instructor over there at the Options Institute. But the reason he's on this program is he's also the author of the brand new and, shall I say, weighty tome, listeners. It is Option Strategies for Advisors and Institutions. This is hot off the press. I might be literally the first person in the world to hold this, aside from you, Russell. Is that correct? Do I have that dubious honor?
My wife and kids have copies as well.
I thought I beat them, but it's okay. Well, Russell, welcome to the program. And let's start there. This is a little bit of a different audience than Volatility Views, even though there is some overlap. So for all of our listeners out there who may not be familiar with what it is that you do, give us a little bit of an overview of your background in the options market and kind of how you found your way over there to the Options Institute, let alone writing this epic and weighty tome, sir.
Well, first off, you keep saying epic and weighty tome.
It's 3,000 pages. I'm looking at it right now.
Oh, my gosh. It's 114 pages. It's a manageable book. I was actually, when I got copies of it, I was like, man, it almost feels like a pamphlet. So it's not weighty, and it's not one of these situations like when you're an author for Wiley or McGraw-Hill. They actually require you to write a book that's at least 80,000 words, so you try to get very wordy in those things. Self-publishing for the first time, I'm actually able to kind of focus in on the topics at hand, and I think it's a pretty manageable book. I also got to price it much lower than a lot of other investment books, which makes it more affordable, and hopefully we'll get it out to the masses. Now, as far as who I am, I'm Director of Education at the Options Institute. I've been there for about 7.5 years. Before that, I actually had a pretty extensive buy-side background. I worked for a couple of hedge funds, worked for the investment arm of an insurance company, worked for a trust company, and worked for a long-short mutual fund as well. So, and at all the different firms that I worked for, the majority of them did use options. But like most institutions, we basically stuck with covered calls as an exit strategy or cash-secured puts to get into stocks. And then every once in a while, when we would think that the market might be ahead of itself a little bit, we would actually maybe buy puts or put on a collar or something like that. And that's pretty much the strategies that are covered in the book, just the basic strategies that institutions who aren't using options should be considering if they're going to make the jump to using options.
All right, since we're talking about strategies, let's get right into it. Let's get into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to our Options 101 segment. Like the name implies, this is the portion of the show where we break down typically some basic options strategies and use cases that you, as a busy financial advisor, may want to explore on behalf of your clients. And so a perfect time to welcome on Randy, kind of education being our topic du jour for the show this month. So actually, I said Randy, I meant Russell. Too many R's on the show today. But you kind of give us a little bit of a taste of it, Russell. But one of the reasons we want to have you on, obviously, and the reason, quite frankly, we created the show is that this is still kind of the Wild West when you're talking about advisors and using options. There certainly isn't a lot of content out there aimed at this audience, this program notwithstanding. And when it comes to educational tomes aimed at this marketplace, I really can't think of many others, if any at all. So you kind of have the market unto yourself. Was that your thought process going into this? Did you go out there and say, hey, no one's really tackling this. I'm gonna take it upon myself, or was there some other impetus behind this very, very weighty tome?
It's like you just said. I don't think there's anybody that's directly addressed the basic ways that advisors should consider using options. Most books, and including a couple of the books that I wrote, they start talking about doing an iron condor if you've got a neutral outlook. Well, I don't think that's necessarily the best strategy for an institution. And then you take a look at some of the professionally oriented books that get very math heavy. I think that scares some people off as well. I think the way that a lot of finance majors are exposed to derivatives in college, which is very mathematical, they're just happy to get through with the class and never address those things again. So I felt like there was a good niche for maybe a book that sticks with the concepts, talks about why you would do a covered call, and then has a few exercises at the end of each chapter talking about, presenting, here's where I'm thinking about exiting a stock, and here are the call options that are available to sell. Which ones should I choose without, throwing implied volatility in there or the Black-Scholes model or anything like that. When we teach the most basic of individuals at the Institute, we always say every trade starts out with a price outlook for the underlying and then maybe a timing of that outlook. Every example for the individual stock chapters in this book does that. We just start out and say, I'm willing to buy the stock a little bit lower. Maybe I sell a put instead of putting in a target price. I'm willing to sell the stock at a higher price, or I don't think it's going to get above a certain price. Maybe I do a covered call in that case. So, and really staying as math light as possible, which is a niche that I really do not think is addressed with options.
Yeah, you mentioned it. It's an interesting audience to approach when it comes to options, the advisors audience, because they're kind of a hybrid audience when you think about it. Because you think about the institutional audience, they're often very sophisticated and they can bring a lot of size to the table and things like that. And these are kind of the 10,000 foot viewpoints on them. Obviously, they've evolved quite a bit. And also the retail is typically viewed as being very basic, and you approach them with kind of more basic strategies. Then you have kind of the advisor audience, and they're kind of a little bit of a blend of the two. Obviously, they bring a lot of financial wherewithal, and they can do a lot of size in any sort of strategy once they wrap their heads around it. But typically from an options, knowledge and understanding perspective, they're still pretty nascent. They're like a very basic retail audience in that perspective. Did you find it that way as well? And then also, from our perspective, I'm sure maybe for you as well, it makes it a little bit challenging to find the right approach for them, because you don't want to talk down to the advisor, but you also don't want to talk over their heads at the same time. It's an interesting balance. Did you have was that a problem for you guys as well? Because we encounter this all the time with a program like this.
It's a problem with just about every advisor office. There always seems to be nobody that's using options, or if there's one guy in the office that is using options, he's kind of the go-to guy or the option expert. I was in Vancouver last week speaking to a Kaya group, and a guy came up to me afterwards and said that he was the go-to option guy, and in fact, there were people in his office that would hand accounts off to him when he had clients that wanted to use options, because some of the advisors weren't terribly comfortable even at a very basic level, and they didn't want their clients to know that. So they would basically give the option expert in the class their accounts that wanted to use options. Hopefully this book will help bring some of those kind of guys up to speed, and they won't have to go through that step or to rely on whoever happens to be in their office that's using options.
Yeah, it's a delicate dance that we do here all the time. And let me just throw it off to you guys before we dive into some of the actual strategies. I don't know, Randy or Chris, anything you want to add here before we dive into the actual meat of the book?
No, I think it's great that a book like this finally being...
Go ahead, Chris.
I'm sorry. I think it's great that a book being written towards this audience, because like Russell mentioned, it's usually, you start off with the retail group, and to get them to the next level is always a difficult challenge. There's a lot of resources out there from the OIC. Skiball has great websites as well, to build a foundation. And I think this is after advisors build that basic foundation with, employing the website that the OIC has created, then, this is a perfect fit for them to take on, their knowledge to the next level and really add value for their clients.
Randy, any thoughts here before we dive into the meat of the book itself?
No, I've had similar experiences with dealing with different advisors across the country. I mean, obviously our bread and butter is working with advisors that want to use options but don't necessarily want to do it themselves. But you definitely get a broad mix of people out there that want to go down this path.
All right, so let's go down that path. Let's get started down there, Russell. Obviously, the book is called Option Strategies for Advisors and Institutions. So walk us through your approach to this book and what strategies did you really focus on? You said you kind of didn't want to blow them away with math. You didn't want to get into the implied volatility. You kind of wanted to get into more of the use cases for advisors. So what did you come down on? What strategies did you actually profile in the book?
Well, I think at any level, it doesn't really matter. The very first best option trade is a covered call. If you're an individual that has owned stocks in the past, you're thinking about getting involved in options, and you got a stock that maybe is at a price where you're willing to sell the stock or willing to let the stock go, selling a call option instead of putting a limit order in, I think that's what I always suggest as a first option trade. Now, that's the first chapter that addresses strategies in the book. The second chapter is one that a lot of retail clients shy away from. It's also one that I know the guys at Berkshire Hathaway use an awful lot. It's cash secured puts as an entry to enter a stock. If you're willing to buy a stock on weakness, stock's not down there yet, and most of the firms that I worked with, when I was on the buy side, we would always we'd have stocks that we liked for the long term, but we're not necessarily willing to step up and buy at current prices. Sell and put options against those against cash that you have available to pay for those shares. I think it's an underutilized strategy by advisors and institutions, and I think there's a lot of opportunity to enhance performance there. And then the last two chapters, there's a chapter introducing index options, which is probably the most basic educational part of the book. And then I have two chapters that talk about index strategies. One is portfolio hedging. I discussed buying a put outright, maybe buying a put spread. A lot of people don't think about that, but it really hit me when I was at one of our risk management conferences. We had a derivative strategist who said she often if you're thinking about hedging a portfolio, she says, take a look at the 10% or 20% out of the money put option and consider selling that one, because when we get those round number drops off of the highs, that seems to bring in some buying. So I thought that was kind of an interesting approach. I talk about selling an out of the money put to help pay for some of your portfolio protection, and then I address a collar as well. Without getting too specific, I just talk a little bit about maybe buying a put for your overall portfolio and then selling calls on individual names if you're thinking about trying to, again, pay for that insurance one way or another. And then I finish up addressing some of the better systematic strategies that we have indexes on at CBOE, the 2% buy right on the S&P 500, the put right on the S&P 500, just a handful of the systematic strategies. So, and that's, as Mark kept kidding around and calling it a tome, it's a pretty brief book, but I think it hits on the most important points for advisors and institutions. And one of the drawdowns for some of the non-self-published books is they really do make you write a certain number of words, and then I think you start stretching things, and maybe some of the major points get diluted a little bit. So there's no dilution in this book, that's for sure.
Glad to see you included Put and a few others. Got to keep the old employers at SIBO happy there with the mention of all their various. Of course, they do have a lot of products, BXM and others that we talked about many times here on the show that are suitable, very much so, for this audience. I'm kind of going through the table of contents as you're speaking. You can kind of see a little bit of a narrative unfolding. You start off, like you say, with the covered call. So obviously, that thought process being, what can a lot of these advisors who have long equity portfolios, which is the vast majority of them, what can they do in conjunction using options with that portfolio? Then you kind of leverage into the cash secured put in chapter 3, that of course being a way that they could get into the stock position if they are so inclined. Then you get a little bit meatier into some of the index products and things like that. Was that kind of your thought process? You wanted to make it approachable in that sense, start off with the basic position that all of the advisors have and how they could use options in conjunction with that, then kind of spread your wings from there?
Exactly. I think using options is not like riding a bike. At one time or another, it's probably come up in most people's careers. But if you're not keeping up with it on a pretty regular basis, you start to fall off very quickly. And that happened to me at one point in my career, where there's about a 2 or 3 year period that I was not using options. And when we decided we were going to sell some calls against some positions that we owned, I was actually getting my college textbook out just to double check some of the things that I was doing. And again, I'm having to dig through some of the more difficult parts of the Hull textbook to get to what I want. Well, hopefully, this book is getting you past all of that.
Yeah, it's a pretty interesting read. Like I was joking, obviously, it is not a dense tome. It is only 100 some odd pages, which I think is also appropriate for this audience. I always joke at the intro, the busy financial advisor, and they are indeed very busy. One of the more frequent counterpoints I hear whenever I approach an advisor about, hey, do you use options? One of the most frequent pushbacks I get is, I just don't have the time. And I have how many thousand separately managed accounts in my thing, or how many hundred, and to have to roll calls across all of them and babysit all these positions. I just don't have the time and or the wherewithal to do that. So I think it makes sense to have a much more sleek type manual that they could go to and refer to. And there are some concrete examples in here. So listeners, if you want to say, hey, how does it work out from if I use this, what is my break even? What is my actual? You have the old school max payoff diagram and things like that. The expiration graphs, which both are loved and maligned in equal measure in the world of options education, but they certainly have a place. So a lot of interesting things you guys can get into. Before we keep going, we have Chris and Randy beaming in via the magic of telephone from different parts across the continental U.S. and even beyond. So I want to make sure you guys have a chance to ask any questions. Maybe, Chris, we'll start with you. Any thoughts or any questions for Russell here before we move on to some of the other topics in the book?
Yeah, after getting through this book, what would you recommend for financial advisors to move on to?
Maybe the next book I write.
Okay, well, that's a good one.
Aside from the shameless self-plug, sir.
We do, and we do offer, and I think you guys have attended this before. We offer a class at CBOE that's specifically for advisors and institutions. It's actually coming up next week, and we've already got several people signed up for that. I'm planning on doing a series of webcasts that will stay on the CBOE website that reinforce everything within this book. So, that will be available as well. And then there's always, and you guys know better than anybody, there's just a matter of actually getting in there and actually doing some of the trades. And I think one of the things I suggest is, let's say, in all of my examples, I use one lots just to keep trying to keep the math simple. But if a firm owns several hundred shares of IBM or whatever, and they'd be happy to exit it maybe at 165, 170, which is a little bit higher, consider just on a small piece of it writing some options. And once you have that position on, you're going to pay attention to it, regardless of what size it is. One of the things that I always steer people away from, and maybe it's just my lack of attention to detail, is trying to paper trade to get a feel for things, because it's just not the same. And, unfortunately, at some point, you've got to take the dive and get in there and do it. And, the covered call is just, you can't do a whole lot of damage with that. I don't know how else to put it. You might not be particularly happy if you wrote calls on LinkedIn a couple of days before the stock went up 70 points. Because those things are going to happen, but I think it's a good way to start to get a feel for it, and make sure that you're talking to somebody that's got more experience than yourself, because you always feel like you're 95% sure that you're doing things right. You always want somebody to give you that 5% assurance so you're doing things correctly.
I just want to add another point. I agree with you completely, Russell. And when I'm teaching courses, I stick with the one lot, right? The one lot wonder. And I also agree with the fact that paper trading can go so far, and after you build the confidence and with the book that you wrote and what's available on the websites, it's really, you have to get your feet wet, and paper trading can only take you so far until you make that next level, the next leap for the next level, if you will. Yeah,
most definitely. Just having somebody by your side helps an awful lot. Just makes you feel a little bit better about it.
Hey, Russell, this is Randy. I do have a question for you. So I think one of the dilemmas that a lot of advisors will have is, when you make that decision of either our firm is going to do the option strategies and trading or use another firm like Swan or some of the other firms out there that do what we do. Do you discuss that in the book? Because I guess I would use the example of when you talked about, I've got 1,000 accounts and can I really do that logistically with my firm? I mean, that's got to be a big dilemma of, having the expertise is one area, but then having the bandwidth, having the systems in place to be able to trade on that kind of level. I know that Swan has invested in a lot of proprietary technology over the last 5 or 6 years to really be able to scale up and offer our strategies on literally thousands of accounts. And I just think that's got to be a big decision for a firm to go down that path and say, yes, I'm actually going to do it myself, and I'm going to dedicate, full-time traders to do stuff like that.
Yeah, it's definitely a manpower and probably a dollar investment as well. I actually know, at the Institute, we deal with just about every level of firm. I know there was a big sell-side firm that was thinking about putting together options education for their brokers, and the back office actually put a halt to that whole program because they didn't want to have to deal with, settling, booking, segmenting, all the different option trades that they felt like they were going to get once they got their advisors up to speed. Basically the guy that ran the back office part of this firm went to the compliance guys and said, we really don't want to move forward with this because of the issues that you're addressing. I don't talk about it in the book, but I've seen it. I've seen it firsthand that some firms, they don't. This is going to sound terrible, but they don't use options because it's too hard, and it's not because the knowledge part's too hard. It's because some of the operational things that go along with using options are too hard.
While you were talking, Russell, I'm just going through your weighty tome here.
You've read the whole book
read the
already.
whole book by the time the program has been completed. One of the chapters here kind of caught my attention as well is the portfolio hedging. That's a question we get very frequently from a lot of asset managers and advisors is, how can I use these options things you guys always talk about in some sort of conjunction with my hybrid mess of a portfolio? How do I make all this kind of pay off? So there's a challenge there of obviously figuring out what your approximate beta is and then figuring out some sort of a hedging ratio / strategy you can utilize there. So do you walk through that in that chapter and to give us an overview of kind of your approach with that chapter and what you're laying out for the readers there?
Well, what I lay out is I just basically say the markets. I actually put the chapter together when the S&P 500 was almost right at 2,000, which made it really easy for Actually, I think I went back to get option pricing from a day that the S&P 500 was very close to 2,000. And I said, look, you think the market's going to sell off 5%, it's going to happen in the next month. And we have month-end SPX options, so then I throw out lots of different alternatives with respect to, how aggressive are you, how much do you want to spend? I think the 1 month option 1 month at the money put would have forced you to give up about 1.5% performance, which I don't think a lot of, when you're playing the relative performance game, that's a lot. And then I, talk about the alternatives of finding a put option to sell. I use the 5% example. I say, all right, so we're at 2,000. You're worried about a 5% sell-off. That's about how much you think the worst-case scenario is. And let's take a look at selling the 1,900 strike put against buying the 2,000 strike put. And then I discuss, I give you a handful of call options on the other side to say, all right, well, maybe you think 2,000's the top, so you sell an at-the-money call, or maybe you think the top might be 2050 or something like that, and you want to participate up to there. So let's sell an out-of-the-money call, and that's the collar that I suggest constructing there.
The collar. You get right to my next question. It's like you've done this before, Russell. You've done this radio thing before, because that's kind of something we've alluded to on this program as I've often only semi-jokingly referred to it as the holy grail for the financial advisor when it comes to options positions, because it combines the two things that 98% of them seem to be looking for out there. Looking for some sort of basic portfolio protection. It combines some sort of income component, and it wraps them up in a nice little bow that they could usually wrap their heads around, particularly if you're talking about, not my favorite use case, but the old zero cost, keep it in the same month type, set it and forget it type collar that most of the advisors can wrap their heads around. Of course, obviously, collars get a little bit more funky when you start playing around with the legs a little bit. You push the put farther out, you move the call closer to kind of maximize the theta impact on both, and you can get a little bit more complicated there. But the collar in and of itself, I think, is a very appealing strategy. I was kind of looking, when I first picked up your book, I was kind of expecting to pick it up and seeing a whole chapter just called the collar. If you even borrowed my terminology of the holy grail for advisors, I would have smiled. I would have sent you an invoice for for copyright theft, but otherwise I would have said you could use it. So what are your thoughts there on that kind of that collar position? Are you as big a fan of it for advisors as we are, or you take a little bit different approach?
I think the collar's a good strategy opportunistically. We actually have a collar, just to be shameless CBOE plugging here, we do have a collar index, which has not had a whole lot of volatility, but also hasn't had particularly good returns over time, just constantly, and you would expect that with respect to the S&P 500. I didn't get overly dynamic with respect to the collar in the book, again, because I was trying to keep things fairly simple, but I do mention that you can mix, and I think the better way to do a collar is to mix up your time frames and try to sell a little bit shorter dated call options and take. I'm a huge fan of trying to take advantage of time decay in any way, shape, or form. So I think the collar, as basically presented, is not necessarily the best strategy, as you mentioned. I think there are lots of deviations around that probably would require, that's probably something that I need to put into a video that will accompany the book.
Yeah, I'm sure there are going to be quite a few webinars and videos and maybe a few podcasts or two that will, just like this, that will be devoted to exploring the many, many different examples in this weighty, weighty tome. Speaking of many examples and weighty discussions, I know, Randy, you have a few more questions for our guest here, so have at it, sir.
Yeah, my question is, do you, in your book, do you ever discuss the time structures of the different option strategies that you maybe employ? I think you mentioned earlier about buying maybe a 1 month out of the 1 month option to expiration. Do you go through different time cycles and use different types of options and different strategies in your book?
Absolutely. For the individual the strategies for the individual stocks at the end of the covered call and cash secured put chapter, I basically lay out a scenario in a couple of paragraphs, and then give you the alternatives of different options. And I use weeklies, actually. I say we're a willing buyer of a stock at a certain level, and we take that strike price, and I say, here they've got 5 or 6 weekly expirations in a row. Which one on a dollar basis and a timing basis might work best for you. Also, when I go through the covered call and cash secured put chapters, I give examples of where they sort of worked. And what I mean by that is maybe a stock got above a level, above the call strike, and then fell back below it by expiration. And what I try to do is emphasize that you may want to think about shorter dated options, not necessarily because you might do better as far as time decay goes, but because you might have a better chance of getting out at the price you want to get out at if the stock rallies up above the strike price. If you go too far out and you haven't experienced enough time decay, that option, the call you sold might actually end up hurting you as far as your exit price goes. So I was very cognizant of having different expirations as examples in there, and part of it's because a lot of institutions are not trading weeklies, they're not paying attention to them, they may be sticking with what they're used to, which is the third Friday options, and I definitely wanted to make them aware of those alternatives.
I think I see revision 1 and revision 2 coming down the road is the weeklies, and then now you guys at SIBO, keeping it in the SIBO family, you guys are adding dailies. Pretty much every other week there's a new daily coming, at least in the SPX. So I see revision 2 perhaps being the dailies. What do you think?
You know how hard it is to keep up with what's going on. That's one of the reasons the book is not bigger. The day that I actually sent it in to be published, CBOE actually announced the SPX weeklies that are going to expire on Mondays, and I just let that one go. I did mention several times in the book that you want to check every once in a while and see if there are new ways to trade available because where I work keeps coming up with them.
Yeah, it's the SIBO's fault for creating all these new things. But you're right. The advisor audience, like I was saying earlier, kind of the big pushback for them is time management. So they haven't been the biggest people to flock into some of these shorter duration products like the weeklies and the soon-to-be dailies that we already have a few of already. They're probably not the biggest audience for that, but they are growing in interest. And if they do want to maximize their way to take advantage of decay, weeklies certainly should be in that conversation. But maybe the audience isn't quite ready for weeklies just yet. Like I said, that'll be version 2 of the book, Russell. I've already done your homework for you. I mean, I'm making your life very easy over here. Randy, any other questions here for Russell or Chris? If you have any more, now is the time, sir. Have at it.
Yeah, just another comment on the weeklies, not necessarily a question, but I think the only 2 days left now are going to be Tuesday and Thursday that don't have any expiring options. Is that correct?
But it depends, because we have month-end options, and if the month-end is a Tuesday or a Thursday, we've had a few instances already where the month-end has been a Thursday, so we've had Wednesday, Thursday, and Friday expirations in a row. I think June 30th, July 1st, July 2nd, or sometime very recently we actually had that happen. So it probably is a matter of time before we have SPX options expiring every day. It's always dependent on how the next rollout goes, and the next rollout is Mondays, which are going to start expiring, I think, in the middle of August. The thing that I actually, if they ask me, and they don't ask me, they just tell me what they've come up with, but I think options that expire the trading day after an earnings announcement would be great for individual stocks.
That's an argument we've been having on one of our other programs on the network, the Option Block. We've been doing that program for 5 years, and nearly 5 years on that program is some sort of limited pilot, whether it's an after hours, whether it's just limited to around earnings, could be after hours, could be during the day, whatever it is, just to kind of give a little bit more flexibility, because we, particularly from our retail audience, get this question all the time, particularly around this time of year, earnings seasons, when I know it's going to start coming in again en masse, which is, how come I can't trade my Google calls after hours or whatever the case may be, and they typically want to do that around earnings. So I'm with you there, Russell. I would love to see some sort of limited pilot, whatever form it takes, on adding some more liquidity around earnings, because that could certainly, I think, be beneficial to the retail, and I think for the piggyback function of that being a lot of the advisors who want to deal with that retail audience, they would have that extra option, pun intended, when they want to trade around those earnings times.
Yeah, I think something like that, or even SPX options. Of course, the alternative around this would probably be limited, but maybe whenever we've got an A level or a B level economic number coming out one day, to make sure we have an expiration on that day. Friday we've already got the employment number, and then Wednesdays are conveniently when we get those FOMC announcements. I think GDPs might be on Thursdays. I can't remember that off the top of my head, but that something like that would coincide with a major announcement.
Yeah, I'll definitely love to see more options, pun intended, out there for the advisor audience. I was just looking, actually, while you're answering Chris's question, I was looking back in your weighty tome, Russell, and looking to see the answer to one of his earlier questions, which is, what are some other book recommendations? You do have a huge resources section in the back of the book where you list all the different books you use and other data sources. So listeners, if you're interested, when you check out the book, when you buy Russell's book, you can get all of the resources. He does mention one good one on the top of the head, which is, of course, obviously Natenberg. You can't go wrong with the Natenberg option volatility and pricing, kind of the Bible for a lot of people in the business. I know that's how I got my start. So there's a lot of books like that and a bunch of others maybe you haven't heard of in that book as well. So if you're checking it out, make sure you check out the resources portion at the end. And before we wrap up here, Russell, on this subject, I'm just kind of curious. We talked a little bit earlier about kind of the evolution of the advisor's audience. I know the book is still fairly new. You kind of just published it a little while ago, so you haven't had a chance to really go out and beat the drum for it yet, except for this program. But in your many day-to-day dealings with advisors and other people over there at the Options Institute, what are your thoughts on the evolution of the advisor audience? You know, years ago, when we've been doing the Options Insider Radio Network for coming up on 10 years in January, which is crazy. And when we first started this program, or first started this network, the advisor penetration from an options perspective was completely nominal. It was not there at all. And it's obviously evolved. I like to think this program has played a little bit of a small part in that, but what are your thoughts there on kind of the evolution of this audience? I'm assuming from the fact that you wrote the book that you think they are receptive to this material these days.
They're becoming more receptive. I think I think CBOE has done a really good job with the wide variety of indexes that we have available now, showing that options can lower volatility and enhance returns. And having that tool available, I think it's very useful when you're trying to introduce individuals or maybe trying to convince individuals that they might want to be interested or that they may want to allow option usage in their portfolio. So, you know, that I think CBOE's efforts around that and the Options Institute's efforts around that as well, trying to help bring options into the mainstream, it seems to have become more and more acceptable.
All right, and to give you your plug here, before we even wrap up the show, we'll do it early here, Russell, even though you're going to stay on with us. So if listeners want to learn more about this tome, maybe they even want to buy this 5,000-page opus, where should they go? What should they do?
It's on Amazon. It's available on Amazon. I think that's the only place it's available right now. It's the Kindle version I'm still working on. You have to do your own formatting when you self-publish these things. Just put my name into Amazon. The 7 books or so that I've written show up, and it's the green one and the newest one and the cheapest one.
Just to help your listeners, it's a Russell with 2 S's and 2 L's, and then Rhodes, kind of like the island, but a little bit different, Rhoads. So type that into Amazon. You'll find all of his myriad tomes. And speaking of questions and all that fun stuff, we have a little bit of time left in the episode. I want to make sure you guys get a little love on the episode as well. So without further ado, we're going to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Like the man said, this is the portion of the show where you guys get to take the reins and dictate the questions and where our conversation goes. You can hit us up all the ways our listeners mentioned, or excuse me, our man in the sky there mentioned. So have at it. We love to hear from you guys. A lot of you have. So we'll see how many we can get to here in the rest of the program. Let's kick things off. Randy and Chris, this one is right up your alley. So this is for you, so I'll toss it to you. This is comes from a listener, goes by the handle Nellius, and he or she writes, how did the recent Brexit market meltdown affect the Swan DRS? Very interesting question. I'm sure a lot of our listeners are thinking the same thing. Obviously, this is an interesting, we're coming on the heels, listeners. We're recording this in mid-July, so we're kind of just coming out of the teeth of a very turbulent period in the marketplace. We saw a lot of interesting movements leading into FOMC, then, of course, Brexit really shocking the market with a dramatic move to the downside, then back equally dramatic move to the upside again, and all the turbulence therein. We saw a huge implosion, huge increase first in volatility, then an implosion in volatility. So you guys can talk about this as well. I'm sure it's been a very challenging period to be managing a portfolio in this time. So maybe walk us through some of the interesting challenges, maybe any interesting insights you've gleaned from this period you want to share with your fellow advisors and asset managers out there, as well as what impact this has had on you guys over there with the DRS.
Well, I'll go ahead and start, and then I'll let Chris add on whatever I don't cover. But as a general rule, we hedge our portfolios at all times. So we have a firm philosophy of we don't believe people can time the market. So we always have a hedge in place. So for the large majority of our portfolio, we go through periods like the Brexit is almost a non-event. Obviously, as you get into some of our income trades where we're selling short-term calls and puts and doing various spread orders, that's where it gets a little more dicey. And Chris, correct me if I'm wrong, I think generally speaking, it really wasn't that big of an event. I think we've had more of an issue on maybe the rebound versus the actual sell-off. Chris, you want to add something to that?
Yeah, I mean, that's exactly the case. If you recall, before the Brexit decision, there was quite a good uptick in volatilities across the board. So we were able to position ourselves strategically during that uptick before the announcement. The announcement comes out. I don't know if you recall, actually, the Monday after the announcement, the SPX was still moving down and volatility was going down. The VIX was going down, and everybody was asking, well, this isn't supposed to happen. The market's down 3%, and the VIX is also down. So we were actually positioned very nicely for that move. The recent bounce back and the almost 8% rally that we have had since the Brexit announcement has been more of a challenge than managing the volatility. So it's really, it was a big directional move that's been much more challenging than the actual move in volatility that we witnessed before the announcement and subsequent reaction and volatility after the announcement.
Interesting stuff. I think a lot of people would be curious to see how you guys weathered that and how it impacted you. And interesting to see that it wasn't that big of an impact, and maybe the upside was more challenging, which certainly makes a lot of sense. Here's a good one for you, actually, Russell. I'm glad to see you stuck around here in studio. You're rewarded with a question. This is right up your usual alley. Your day-to-day isn't usually talking about financial advisors and options. You usually like to spend a lot of time looking at the VIX. This question comes in here from a listener who goes by the handle Skiball. He or she writes, where do you see the VIX going, and how will it impact stock picking in this market? Interesting question. Maybe we'll start with the latter first, Russell, because kind of the more general, interesting one, I think, for our audience rather than our random vacillations on VIX cash. They can get a lot of that if they go to Volatility Views in our Crystal Ball segment. But obviously, a lot of froth, a lot of volatility, a lot of Sturm und Drang in the marketplace makes it a little bit more challenging to be a stock picker out there. So walk our listeners through some of those impacts when you see, relatively, comparatively speaking, high level of VIX versus, low level of VIX, and some of the challenges for you as a traditional, asset manager or financial advisor may encounter in those different scenarios.
Well, if managed properly or anticipated properly, just like the Swan guys were talking about in the previous question, if you are fully prepared, or I shouldn't say fully prepared, but if you have the ability to take advantage of extra market volatility or sell-offs, that means that volatility is going to be your friend. You just got to be prepared to and not get too terribly emotional when we get situations like we did around Brexit. There are a lot of shoulda, coulda, woulda people that didn't keep their heads about them when the market did what it did on Friday after Brexit. And then again, like the guys mentioned, on Monday, the market continued to sell off a little bit, and volatility actually came down as well. Maybe using the volatility as an indicator in situations like that tell you when it's time to possibly get back involved in the stock market. It just happened very, very quickly this time.
Yeah, it has been a turbulent period. If you like a lot of that talk, then by all means tune into our Volatility Views program, where we spend a whole hour doing a deep dive into all things volatility. I don't know, Chris, maybe you or perhaps Randy, you have any interesting thoughts you want to add here? I know you guys really don't. You watch the VIX in a 10,000-foot view because obviously there is a premium harvesting component to the DRS, but you're not kind of glued to the VIX day to day. But any thoughts here for our listener about how VIX impacts their challenges going forward from a stock picking perspective?
I'm going to go ahead and let Chris answer that. Go ahead, Chris. Sorry.
Well, yeah, sure. No problem. We do watch the VIX. Like you said earlier, Mark, we're in the business of harvesting risk premium, so it's something that we watch closely. And as far as stock picking is concerned, everyone knows that the VIX can be used as an indicator of when it reaches extreme low levels that perhaps the market's becoming toppy, it's overbought, et cetera. It's very similar to what we're in right now. One of the interesting interesting things about low VIX readings is, they're for short periods of time. Now, I don't want to put my foot in my mouth, because what is a short period of time, especially when we have weeklies now and dailies, and you can trade a 1 day, 2 day, 3 day option. So, be careful when I say short period of time. But if you go back in history, the lowest level reading in the VIX was back in December of 1993, and we've had periods such as July 2005, December 2005, when the VIX was flopped around in the 10 handle. That was just for 1 month approximately. Then we had a 3-month period, December 2006, February 2007, when it flopped around between 10 and 12. March 2013, another low period. June, July of 2014, another low period. So you're going to see the VIX go sub 12 or below 12 anywhere from 1 to 3 months. So it's just something to keep in mind, and it usually is a decent indicator that, the markets are a little toppy, a little overbought, and some type of correction is probably on the horizon. So as far as individual stock picking is concerned, well, I would take it from the stance that if the overall index is down, then 3/4 of the individual equities, the components are going to be down as well. So they do have VIX on individual stocks out there. You can go to the Skiball website. I know they have them on Amazon and Google, and a few other equities. So you could probably apply the same concepts that you use with the VIX and the volatility indices with individual equities. But, I'm still a believer that volatility is an input to a model. There's a negative correlation between volatility and the underlying. The other thing that the challenges in modeling volatility or guessing where volatility is going to go is A, I need to know whether the stock's going up or down. B, I need to know the speed of that movement up or down. And the third thing really is, well, what's the natural supply and demand of options? I mean, who's buying options and who is selling options? Those are some of the challenges in trying to estimate where volatility is going to go in the future.
All right, we got time for, I think, one more here. Keeping with our theme of options education, this question comes in from Ignacio Real. If I butchered that, I apologize. He writes, "This is a very informative program." Well, thank you, Ignacio. You're a man of discerning taste. He goes on to write, "I would like to ask you to please explain the benefits and drawbacks of credit spreads and debit spreads. Why should I utilize one versus the other? My clients' portfolios typically utilize retirement assets with the goals of capital appreciation and income. Your input would be most welcome." Well, Russell, this is right up your wheelhouse as well. I'm sure you get this question on a regular basis in your day job over there at the Options Institute. But it's an easy way to see, or easy to see how people might get, misconstrue these two ideas. I know one of our cohorts would say, there's no difference between a credit spread and a debit spread. But to a newcomer to the options world, one is clearly more appealing than the other. One pays you a credit, one costs you a debit when you're executing them. Obviously, he doesn't give us any specific examples in terms of any underlyings or strikes he's looking at, anything like that. So we kind of have to talk 10,000-foot perspective. But that said, what are your thoughts here for our friend, Mr. Real? Why should he be using credit spreads versus debit spreads, or vice versa? And any thoughts you have therein, sir?
Well, if you're talking about individual stocks, credit spreads make more sense than debit spreads, because your goal is for this underlying stock to be higher than both strike prices and both the options to expire with no value, which means you don't have to go through the exercise and assignment process. If you do and just for example, a credit spread, if you're bullish, would involve selling a higher strike put and buying a lower strike put with the intent that they both expire with no value at expiration. You could do this. You could quantitatively do the same thing with call options. And you would have, one call that has more value than the other call at expiration, but they'd also be both in the money. So you would actually have to go through the assignment and the exercise and assignment process, which might have some fees associated with it, which is one of the reasons that some traders prefer the credit spreads. Now, when you do these things with index options, there really isn't that much of a difference, because the index options are cash settled, and you don't necessarily go through a delivery or assignment process. You don't end up possibly owning shares or short shares of an underlying as well. That's the major difference between credit spreads and debit spreads. And for individual stocks, if you think you're going to be right, you wouldn't do the trade if you didn't think you were going to be right. You probably want to lean toward a credit spread.
Randy or Chris, same question. Any thoughts here on the age-old battle of the debit versus credit spread, particularly for an advisor who wants to utilize some of these strategies on behalf of his clients for some long equity portfolios?
I'll go ahead and take that one. I think it comes up to what you're comfortable with. You're going to trade what you understand and what you know. As far as credit spread, debit spread, I mean, through synthetic relationships, they're really, and it comes down to risk reward. So it depends what you're comfortable with, how you want to approach it, and that's the vehicle that you should trade.
Well said, sir.
Absolutely.
Thank you, sir. Well said that, at the end of the day, it is what you're comfortable with, and that's the best way to get started and kind of go from there. But good question, Ignacio. We probably can answer questions for another hour, but unfortunately, that's all the time we have for the office hour segments, also all the time we have for this episode of The Advisor's Option. Before we go, we'll start with you, Russell, as our guest. We had a little plug earlier, but if listeners want to go to find not just this book, but everything you're working on, should they just go to Amazon or maybe to your own website, or where should they go to find all the works from Mr. Russell Rhodes?
Just about everything I do shows up on the CBOE's blog site, which is all one word, cboeoptionshub.com. So just about everything although I haven't written anything about the book yet, anywhere we're going, anything that we're doing shows up there one way or another. I don't know if CBOE would be really happy if I had my own website.
There you go, the Options Hub over there at CBO. Check it out to find Russell's daily blog and other stuff, and then go to Amazon if you want links to his many, many myriad options tomes. And Randy, you guys are working on a lot of interesting things over there in the land of Swans. Why don't you give us an update? What's coming down the pike in the land of Swan Global Investments?
Well, of course, we have a regular, blog posting and a lot of research that you can go to our website and get. I think the biggest thing on the horizon right now is that we took the successful inaugural CIO conference that we did in Puerto Rico that you were obviously at, and we're taking that to various cities around the country between now and the end of the year. I think we're shooting for about 20 this year. So we're gonna give advisors the opportunity to participate if they so choose, to come to this and watch kind of a mini conference of what we did in Puerto Rico in April. So that's a good opportunity for people to get a very condensed version of what we did in Puerto Rico. Like I said, I think we have a website that you can go to and actually get that information of what cities and when we're going.
Yeah, I believe you have a site. I'm just trying to pull it up now because it's not available on the actual Swan website. But we'll get the link for you listeners in the show notes. You can find all of the places where they'll be doing the updated versions of the Swan Investment Conference. And it was a pretty interesting event in Puerto Rico. I'm looking forward to seeing other ones. And certainly when you're bringing it to Chicago, I'm looking forward to coming and seeing it in person yet again. And on behalf of Randy and Chris and Russell, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. Keep them coming. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.